ushering in 2019 with one of the most prominent voices that can analyze the global economy. Dr. Willem Buiter is chief economist, Citibank, but more importantly, in his previous avatars, Buiter has been member of the Monetary Policy Making Committee of the Bank of England. So he's a man who has worn many hats in the past. Dr. Buiter, thank you very much for joining us. We have to talk business, and let me start at the heart of the market sphere. Dr. Buiter, while the Fed may have said that it is reducing the number of rate hikes, the fear is that the Fed's balance sheet reduction is on autopilot, that it will reduce its balance sheet by the pre-decided amount. Is that a right, premise?
The Fed's balance sheet has never been an autopilot. The schedules that they produced just reflects the expected or the planned balance sheet contraction. If there are objective economic circumstances, such as a sudden tightening of financial conditions, that warrant an interruption or even a partial reversal of the balance sheet contraction, it will happen. They're not set in stone.
All right. Well, the Fed last time decreased its rate hike guidance for 2019, reduced it from 3 to 2. But what is your sense then? How many rate hikes are you factoring in? And as well, once again, to come back to the balance sheet issue, how different will be the balance sheet contraction, according to you, vis-a-vis the guidance of 50 billion per month?
No, I think we're going to see a couple more hikes in rates, most likely in the US, probably later in the year, not March, but more like May or June. And I think we will, for the time being, continue to contract the balance sheet in this very gradual and measured way of 60 billion a month. The Fed will not change its course of action there unless there is visible evidence of faster than expected weakening of economic activity in the US, both current and prospective. And the Fed is, I think, somewhat more optimistic about US real economic prospects than the markets, which accounts for the dichotomy in sentiment between what the market feels, which is fear and loathing, right, with the worst year in the stock market since 2008, and what the Fed seems to feel, which is an economy which, in terms of the real economic activity, unemployment and inflation objectives, is still broadly on target.
Okay, so now that'll be a bit of a worry if the Fed thinks the economy is doing better than the market thinks it's doing. Now, let me come to the other worry for financial markets, which is the tariff war. Do you think US and China will find common ground on tariffs before that 90-day deadline expires?
We really don't know what's going on. Yes, we had another, what was it, 4-hour or whatever telephone conversation between Xi Jinping and Donald Trump, but the meaning of that in terms of concrete progress in the trade negotiations is, I think, very unclear. And remember, these aren't pure trade negotiations. These aren't even trade plus tech plus intellectual property right negotiations. This is the new Cold War between a rising hegemon, an hegemon in the ascendant, which is China, and a hegemon in relative decline, which is the US. And that particular fight for global and regional dominance, preeminence, will be fought out in a range of arenas, not just the economic, no matter how broadly define it, but the diplomatic and potentially in different regions, even military. So there is a lot on the plate of Mr. Xi Jinping and Donald Trump that goes way beyond the normal trade negotiations that we've seen between the US and Canada and Mexico. Those were trade negotiations. Right? Between the US and China, this is global dominance negotiations.
Okay, I take that point. It's a Cold War. It's a new Cold War, as you put it, between the largest hegemon and the rising second largest hegemon. So, do you expect 2019 to be a year of, slowing growth, falling investments because of all these uncertainties on the trade front and other fronts?
Oh yes, definitely. This is our central projection. The global economy will slow down, driven by China and the US. The US because of domestic reasons, the unwinding of the fiscal stimulus, and China also because of domestic reasons, the unsustainable credit and debt boom and bubble that they have been using to drive the economy forward since 2008. And on top of that, we have the trade wars, and on top of that, we have the economic uncertainty created by the temporary suspension of part of the government in the US, plus uncertainty in Europe. No. There's no doubt that this will affect capital expenditure worldwide, and this will affect property values, and this will affect asset market valuations. So I don't think we've seen the worst of the stock markets yet, for instance.
Let me come to the other issue which has troubled financial markets. We have heard President Trump threatening to fire the Fed chairman, Jerome Powell. Do you think if the Fed persists with its rate hike calendar or balance sheet contraction, as you say it will, the president may actually fire Powell?
That is, I think, rather unlikely, because the president can fire the chair of the Fed only, as it's called, for cause. And cause is generally interpreted, although we have no precedent for this, as not excluding simply disagreements about policy. It might be possible, that is firing a governor. It might be possible for him to actually fire Powell as chair, but having to leave him as a governor, which would be a very strange situation, because of course the last rate decision by the Fed board and indeed by the FOMC was unanimous. So I don't think that Trump is going to go there, although you can never be completely sure. His propensity to do unexpected and rather over-the-top things is not to be underestimated. But I think that Powell's position looks safe to me.
Okay. Well, then that's another worry less, though it did send some jitters in financial markets in December. All right. Now, what does all your economic prognosis mean for financial investors? Where will smart money go in 2019? Given the slowdown you see in the US, do you think funds will rediscover emerging markets?
Well, a global slowdown is likely to occur during a period of still rising US policy rates and still quite high US longer-term yields. And I don't see any immediate weakening of the US dollar. So this doesn't sound like an external environment within which emerging markets thrive. Of course, oil prices are weak, and that helps a number of emerging markets, including India. But I think there is enough trouble through the capital account and through the trade accounts, trade conflict related broadly, as to offset the beneficial effect of any weakening of oil prices for countries like India.
Okay. Yeah, take your point. What we may get by way of lower crude prices may be taken away if there is a major foreign investor outflow. Okay, let me come to another issue. Since we spoke about Trump and Powell, our own former governor Urjit Patel resigned, ostensibly protesting the government interfering with his banking regulations and other rules. Now, is this a worry at all for foreign investors that a governor had to resign on principles?
Getting to a situation where the governor of the central bank feels he has no option but to resign to underline and emphasize and maintain as much as he can of the central bank's independence is not a good place to be. Right? It may have sort of short-term benefits in terms of more relaxed credit conditions, credit growth in the run-up to the elections in 2019, but clearly the country will pay a price for this undermining of central bank independence. Yes, that seems inevitable.
Oh yes. Well, do you worry there will be more monetary and fiscal looseness because of this event and the new man in Min Street? And will this monetary and fiscal looseness result in some financial instability later in 2019 or in 2020?
Well, certainly for the next 5 months until the elections, right? I think we're going to have excessively loose fiscal policy and attempts to loosen monetary and credit policy as well. And I think a price will be paid for that after the elections. But since the period between now and the elections is a relatively short one, the damage that can be done, assuming that most of these handouts are going to be partially taken back following the elections, the damage need not be too serious.
Okay. Well, let's hope that way. Then my final question to you, 2019 is obviously important for us because of the major election that we are getting into, the general elections. What's your sense about the Indian growth story? We seem to have kicked off a kind of a capex growth, but with this kind of a political economy backdrop, what's your sense of the India growth story?
Well, I think there should be a slowdown in Indian economic growth simply because of the worsening external environment. This can be offset to some extent by a greater fiscal stimulus and credit stimulus, but that would lead to a more unbalanced economy, a growing trade deficit and current account deficit, and I think a price to be paid through the currency and through capital outflows. So I see for India too a slowdown relative to 2018, and certainly a more unbalanced economy.
All right, that's not really pleasant to hear, but yes, I guess if there's fiscal and monetary looseness, the bill will have to be paid at some time. Dr. Buiter, it's a pleasure having you with us on the first day of the new year and delineating to us what you see by way of economic trends in the US, in the world, and in India. Here's wishing you once again a very, very happy Chetan here, Chief Economist and Global Head of Economics at Morgan Stanley. It's a matter of pride for us that Chetan has gone on in Morgan Stanley from being the Chief India Economist to the Chief Economist Asia Pacific and is now that company's Chief Global Economist. Chetan, thank you very much for joining us and wish you a very, very happy 2019 first up. Let me come to business because the markets are in a tense mood throughout December. All stock markets have tumbled, worrying that the global economy is slowing. That growth scare continued today, after Apple guided to lower earnings, again because of global growth slowdown fears. What's your assessment of the global economy in 2019?
No, we expect some moderation, but we think the growth will be somewhere around the trend line number, which is around 3.5% for most of the quarters in 2019. But I think the bigger story that we have for 2019 outlook is we think that the mix in growth will change, i.e. DMs will slow, but EMs will actually stabilize. And so therefore, the EMs will take the lead in terms of driving global growth in 2019.
Okay, well, that's positive. But first, let me take the DM part a little more on the United States itself. Wall Street indices were among the worst performers in December, and that's the mother market. What are you expecting in the US? And hence, what are you expecting by way of US Fed policy?
Yeah, so we are expecting the US growth to slow meaningfully to 2.3% average in 2019 from the current run rate for the fourth quarter. It looks like it's tracking at around 3.6. So we are seeing a meaningful slowdown in the US in 2019, and therefore we do expect the Fed to pause around the middle of this year. Either it will stop taking up any more rate hikes. But I think, Lata, the bigger issue which the markets are now grappling is with the decision on the balance sheet. So at this point of time, we think the Fed continues to run off the balance sheet until the third quarter of 2019. But the market is concerned that that cannot be taken up by the Fed so aggressively. And so we need to wait and watch. As of now, the Fed has said that, look, if there's a problem on growth outlook, we will alter the rate hike path. But they have not talked about balance sheet. And so I think that's what market is really looking for. If they give a comfort on balance sheet path being also in play as far as overall growth outlook management is concerned, that's what I think will be useful to watch for the markets.
Okay, yeah, we were just discussing that with some other economists. They're not very confident the Fed is as yet that worried about growth to give any indication about balance sheet. But let's wait and see. 4th and Saturday, which would be what, 6th, are important dates. What about the dollar itself then? If there is going to be such cues, then has the dollar peaked for now?
Yeah, we think the dollar has peaked. And look, I think the other side of this is that the EMs are in a better shape now, broadly in terms of its level of real interest rates as well as the path on fiscal policy. So EM's inflation continues to be relatively low. It's at a 15-year low. And so that's also creating a backdrop where EMs are in a better shape. And so we think both in combination, where US is expected to slow, the Fed is expected to pause, and the fact that EMs are doing okay, the dollar will continue to weaken against broader EM space. Okay.
All right. I'll revisit that with respect to the rupee. But first, let me finish the global questions. Coming to China and the EMs, the Chinese Caixin PMI number, which just came, showed a contraction in December. Tim Cook is worrying about Chinese growth. What's your view of China?
So we think China will continue to show some weak numbers for the next 2 months. There has been a compounding of problems for China. One is that they had been taking up deleveraging, and so therefore they were not taking up aggressive easing, and the trailing tightening on regulatory front on the financial sector has actually weighed on domestic demand. At the same time, we have seen trade tensions weighing on their exports growth. And so the combination of this domestic and external pressures has kept the numbers somewhat weak. And we think this will be the case in the next 2 months. But after that, with the cumulative easing that they have announced over the last few months, more particularly in the last 2 weeks, we've heard them confirming that there will be a VAT tax cut taken up of 2 to 3 percentage points. At the same time, they have increased the quotas for the local government bond issuance, which we think will stimulate the infrastructure spending. So from March, April onwards, we should see improvement in China's growth data. So we do think that China's easing will be effective and drive growth from March, April to this year.
Okay. Well, obviously, the most important event for India, monetary policy framework, yes, is there. But the most important event in 2019 is going to be the general election. If by chance there is a coalition, either led by the NDA or led by some non-NDA parties, will that hurt the economic growth trajectory?
I think it will be. So that is a risk. In fact, that is a risk not only for India, but just broadly the EM space. The political risks are there. It's there in India, it's there in Indonesia, in Brazil and Mexico. We are watching for actual policy implementation after the new governments have been formed. So as long as you have a stable coalition government with one of the two parties having upwards of 200 seats, that would be the outcome which will be more favorable for the growth cycle to continue. But if you do get a adverse political outcome, that is a significant risk for India's outlook.
Okay. Well, then now once again a global question. Where will smart money go in 2019? Does it go to developed markets at all? Will a bulk of it go to EM markets? And which asset classes? What exactly is Morgan Stanley advising?
So I think the big call that we made in the year ahead outlook piece from our strategy team was to invest more in emerging markets rather than DMs. and there was a broad-based constructive view on EM currencies as well as EM local currency government bonds and EM equities. So that is the big call that we have made for 2019.
What's your take on the Indian currency? Gentle appreciation, gentle depreciation for 2019?
We have a view that broader trend for the dollar will be that it will weaken. In that context, we expect the rupee to be on a slight appreciation path.
No, actually, you're there so close to Wall Street. Maybe you understand this better. What's your take on this severe volatility that we have seen in US markets and the scary December fall? Will this volatility and this decline end anytime soon? What is it telling you about the underlying economics?
I think the simple explanation of that is that there has been concerns on global growth, not as much the US growth itself. And that has made the Fed a little bit more careful in changing its tone and not talk about a shift in the policy stance. In the backdrop, the global growth data point had continued to weaken. And so to the extent to which the talk from the Fed was hawkish right until first week of October, while global growth data was showing some concern, that's what has created this tension between markets and the policymakers. Now, we have seen one leg move from the Fed that they have said already that they will pause at neutral. That's an indirect indication that they have given. But as I was mentioning to you earlier, they've still not brought balance sheet into discussion, i.e. that balance sheet is still expected to be on autopilot. And that's where the tug of war between markets and policymakers is likely to continue until we hear from them. And that's why I was mentioning earlier that we would be watching the next few speeches from the Fed speakers coming up in the next 2 weeks more closely.
Okay, we will depend on you to watch that and parse it for us, Chetan. Let me just squeeze one more question. We're running out of time. You have been positive on EMs. What is the pecking order, the ranking?
So our strategy team's view is that China, India, and Brazil are the top 3 picks from an equity market space in the emerging market equities.
All right. Chetan, thank you very much for staying up for us in the United States and speaking to us about 2019. We'll hope to see you when you are in India. Thank you very much for joining us. Have a great 2019.